Welcome back to Rich Dad StockCast. I'm your host, Denney, and today we're talking about something most investors don't realize that they're doing: killing their golden goose. The golden goose is simple. It's your ability to generate ongoing cash flow, not just one win, not just one big trade, but income that shows up consistently. And here is the problem. Most investors are so focused on short-term results that they make decisions that quietly destroy their long-term income. They chase, they panic, they overreact, and in the process, they damage the very thing that could have made them financially free. So today, Rich Dad expert Andy Tanner is here to break down how investors accidentally sabotage their own wealth and how to protect their income streams that matter most. And before we get into it, make sure you go to stockcastbonus.com, grab your free investing tools. If you want to build and protect your financial future, that's where you start. Andy, welcome back.
Man, great to be with you, Del. And once again, fantastic topic today. This could be 5 podcasts. There's so much to talk about here, so this will be great.
We have a ton to talk about. If listeners have probably heard before, the longtime listeners, we talk about golden gooses. They put it in the comments. Can't wait to get to it. But there is some golden let's say Easter eggs, if you will, at stockcastbonus.com. There's some great things in
100%.
there. What are some of the Easter eggs, the golden gooses, if you will, that are in there?
Full on golden geese there. Yeah. Well, first of all, it's free, so that's great. And you go there right now. We've got a great ebook. It changes, so depending on when you're viewing this podcast, but right now, as of the recording, we've got a great ebook you can download. And it actually is about cash flow. It's about how to create that pattern, different patterns that you can create in your own financial statement. I show you my favorite one. And I show you how to build it step by step, like literally step 1, do this, step 2, do this. So great ebook, and no charge for that. It's got your name on it. Go sign up for it, and we'll send it off to you.
Fantastic. All right, so let's talk about
hit your inbox before the podcast's over. So there you go.
There you go. Very good. All right, so the phrase "kill your golden goose." So we've talked about it a lot. Maybe we should add some context. So what is it? What does it mean to kill your golden goose when it comes to investing?
Some people never get one alive. It's dead before some people never own one. And, it's fun. I hope I take this the right direction. We never rehearse because I like to have your questions genuine. And so if you ever ask me a question, I don't know, I'll say I don't know. But the place my brain goes first, I think the fastest way to kill cash flow from stocks is to put money in 401k. I think it's the fastest way to kill it. And I'll tell you why. If you've read the book, Rich Dad, Poor Dad, there's a page that I think is the most important page in the book. And I think you can boil why that is the number one personal finance book of all time to really one page. Because as I've talked to, untold readers, they have the same experience I did. It's a picture, not words. And Robert was great in giving things mass, when you can see it and it's tangible. It's not just words that's an idea. It's like pictures give things mass. And so one of those pictures is a cash flow pattern of the poor and a cash flow pattern of the rich. Well, once you start to understand cash flow patterns, you understand how a golden goose requires that. If the cash isn't moving, if the cash isn't being produced by golden eggs being produced, you don't have a golden goose. You don't have something that's producing, right? So think about this for a minute, Del, and I'll draw from one of my books, 401 Chaos, if it's okay. In the 1800s, 1885, American Express was not a credit card company, obviously. They were like UPS. They were like Federal Express. They had a rail system, and they would deliver trucks and they would deliver parcels. American Express. And that makes more sense than being a credit card company, right? And they said, look, we're going to give you a pension. We're going to give you cash flow after you retire. And the rules were terrible. And, there was a lot of fine print where a lot of people never got the pension. But it was the first pension idea. Now, think about that. If you can visualize a financial statement, that's a cash that flows from their liability column, the money they owe you, through their expense column, the money they pay you, into your income column, the money you receive for that pension, and then out your expense column, the bills that you pay. So it never touched your asset column or your liability column, but it was a cash flow pattern. This is very important to understand if people can visualize it. That's why Robert's pictures are so good. It was a function, wealth and retirement and not having to work anymore was a function of income and expenses. It was a function of the income statement because the other balance sheet wasn't even touched. Well, when Ted Benney tweaked that law that was written, and sponsored by Congressman Barbara Conable from upstate New York in 78, in 1980, when Ted Benney changed all this, you'll notice that they took away the pensions and replaced it with the balance sheet. So think about this for a moment. If you ask someone that has a government pension, because they still have them, what's your pension? They'll say, oh, it's $10,000 a month or whatever those, teachers or people make in the gut working for the government, right? It's $5,000 a month, whatever it is. And it's a monthly cash flow income. I get money coming to me with no end. If you ask people and go to the Vanguard How American Saves report, and you find people age 55 to 64 and say, what's your retirement look like? They'll say, well, I've got about $90,000 in my 401k. They list a number, a flat number for the rest of their life. That's not a cash flow number. That is a net worth number, not an income or a profitability or a bottom line or what we call cash flow. So the fastest way to kill a golden goose is to put your money in a 401k where it doesn't pay you every month. It sits there and you hope the piles of eggs get big enough that the value of those eggs increase because you're not going to be producing anymore, and that the number of them doesn't deplete as you spend them to live before you die. It's a race against time where people are more scared of living than dying because they're going to outlive their money. So I don't know if that made sense or if you have comments to clarify it, Del, but if you make your wealth plan a function of net worth as opposed to a function of income, you've not even established a golden goose yet that can produce ongoing income, that can generate income. It's more like putting money in the freezer and going to the deep freeze later and hoping it can thaw out and be spent and doesn't get freezer burn. It's more like putting money in the freezer for the future than having a garden that will continually grow and blossom and produce food annually.
I think you said it right. Just for clarity's sakes, we're focusing on cash flow and not net worth. I think that's the 2 biggest thing. Most people are building net worth and they focus on net worth, but they haven't established cash flow yet in their lives.
They've killed their golden goose before it's born. They've never created one. So by the way, I said we could do like 5 podcasts on this. We have more reasons, but that is the first one, is because of a lack of education. People were presented a 401k to replace their pensions. They're like, oh, okay. And that's not to say that a pension is a good thing, because it's not. The pension, as I mentioned, has no utility whatsoever of the asset column or the liability column. So the asset column is not used, which means that you are forfeiting the greatest compounding power ever, or the greatest wealth building power ever compounding. You will not compound. You get a monthly check. And so there's no utility of the asset column in a 401k, in a pension. And then in both of them, there's no utility of the liability column. Now think about that. No utility. If the liability column is not there to show bad things, it's simply to show the cash flow. And the utility of each column, if you look at it in terms of, well, expenses are bad and income's good and liability's bad and assets are good and wrong, that's not it. Robert used to say this all the time. He'd say, I have a right hand and a left hand, not a right hand and a wrong hand. And the utility of the expense column is key. And the utility of the liability column is key. That could be a podcast in and of itself. But as far as not having a golden goose, 401k is number 1. So when you're ready for number 2, you let me know. There's Number 2, 3, 4, 5, and however many.
We could go. I want to maybe actually shift gears just a touch, and I want to talk about people that are investing, that maybe are trading, maybe that they're
Yeah,
getting into it.
those guys kill their golden goose when they sell because they're focused on price rather than income. If I pull my cash flow jack in the box off the shelf, I don't know that I need to do it, but it has three parts to it. It has the hand crank, which represents the work a company does. It has the cash flow that comes out of the top, like the jack in the box puppet. That's the money we earn, not make, but earn. We do work and earn that money. And then there's a price tag over here. And CNBC is the worst. All they care about is price. Price, 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 price. Wall Street cares about price. 401ks care about prices because they think that stocks are about what the stock is worth, not what the stock produces. So if you had a golden goose with a price around its neck and you wanted to slaughter it, all of a sudden you see the price of the goose go up and say, oh, let's sell this goose. Let's get rid of it. And then someone takes the goose and buys it so they can eat dinner or whatever. And they eat it. They sell it and someone eats it. And then you lose that. So I'll give you a great example. I talk a lot about Exxon Mobil because it's one of the big home runs that came in my life because I bought it in COVID when it was way, way low. It got down in the high 30s. I mean, all I saw was a sale. I'm like, man, we might not be using oil now, but there'll be a day where we're going to use it. Maybe we attack Iran someday and we close the Strait of Hormuz and oil, people start speculating the oil's, maybe $200 a barrel someday, right? So, Exxon tops out what, 170, something like that, 180, 170, somewhere in I don't know. I don't pay attention to the price. There's a temptation to say, gee, Andy, you bought it at 45. My gosh, let's sell at 150. Let's get that three bagger and let's take that profit while we can. Profit taking is a way to kill a golden goose. There's no way I'm freaking killing that thing, man. What would happen right now if I kill it? Well, their dividend has grown in I can tell you the dividends. I can't always tell you the price. In 2020, March of 2020 or thereabouts, you're 84 cents a quarter, 84, 85 cents a quarter. Now you're $1.03. So that's 412 a year. So you buy something in the 40s and you're getting 412, you're 9-10% just off the freaking dividend, kicking your feet up, doing nothing. And they've raised that dividend 40 years in a row. I would place my money, and I have placed my money, that will continue to produce income like a golden goose. Add on top of that, very conservative covered call writing. Why? Because now at the money strikes are over $100 a share. So I invested 40, but I get to write covered calls at triple digit strikes. I can write those so freaking far out of the money that the probability I'd have to make an adjustment. I've made adjustments 3 times in 6 years now? 3 times in 6 years, I've made an adjustment where I've either bought it back or bought more stock to hedge or whatever. And so, I kick my feet up. That's another 10%. Like falling off logs. So you're looking at 18-20% return now on original money invested. Why would you ever profit take and take that bird in the hand? Because the two in the bush are for me the rest of my life, my kids and the family trust the rest of their lives, and who knows how far that goes into grandkids. Why would you kill generational wealth to sell your goose to somebody? And it happens all the time when people die, which is why we do it in family trust structure. Because if you build an empire and then you die and your kids liquidate everything to go party, you lose that cash flow. So profit taking, focusing on a huge jump in price, and I'll probably never see. That's a huge. Let's lock in those profits. Let's take profits. You're losing 20. Do you know what 20% of your compounds at? If you could find other investments to reinvest at 20 with those profits, I mean, you probably won't to start off, but it's food for thought to say, do I really want to kill something that's cranking out 20%? Because 5 years gets you all your money back that way. but you can keep it for 10 to, I don't plan on dying in 5 years, right? I'm not the healthiest guy, but I don't think I'm ready to check out just yet. So yeah, don't profit taking on a cash flowing asset is nutty. Plus you're paying taxes, by the way, if it's not in a Roth.
Now, you brought up a good point about covered calls, maximizing what you're doing. I want to pause that thought. I want to bring that back here in just a second. Let's do this. Let's take a quick break. Listeners, most investors don't fail because they don't have opportunity. They fail because they don't protect it. So when we come back, Andy's going to break down how to protect your golden goose, how to build systems that generate income, maybe like covered calls, and keep working overtime. And don't forget, go to stockcastbonus.com. Grab your free resources. That's where you start building real investing discipline. Stick around. We'll be right back.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
All right, so welcome back to Rich Dad StockCast. Andy, let's talk solutions. Now, if someone wants to stop sabotaging their financial future, how do they protect their golden goose? What do they do? Let's just start with the basics.
Well, it shouldn't be a surprise, and I think that's why people would, Google and wind up here, or just they know, what is the Rich Dad mission? What is it? Well, it's to elevate, it's to lift people up, it's to elevate the financial being of humankind. And that is done through financial education. So if you look at both of the things we talked about in the opening segment, they're both related to financial ignorance versus financial education. Robert is really cognizant always of defining jargon. So I use some jargon called a covered call. Well, some people don't even know what that is. That is not a measure of their intelligence. They're every bit as smart before they learn it as after they learn it. It's just they haven't focused their genius on that area of their education. They can learn that writing a covered call is simply getting paid to make a promise to sell your stock at a certain price. Well, I understand standard deviations. I understand the behavior of that stock, and I can make those promises, much like an insurance company makes promises and collects premiums on things that are likely never to happen. California, terrible, 13,000 homes destroyed. But there's millions of homes that'll never burn down. And they will collect that insurance year in and year out. So, when you ask what is the self-sabotage, it is trying to engage in something that we know very little about. And that is a recipe for disaster, whether you're building a house, whether you're a dentist or wanting to do dental work, whether you're wanting to be an attorney, any of those things that you engage in without sufficient know-how, practice, coaching, help, mentors, teachers, it is a guarantee. There's few guarantees in the world, but you're guaranteed to just have more problems as an uneducated person trying to participate in a market where there's others that are. A person in a 401k is not an investor. They're a participant, and there's a big difference. A person can do surgery. You and I, we can go out and do it. We're just not doctors. Well, people can go out and buy assets. They're just not investors. The term being a doctor or lawyer denotes not only what you do, but who you've become, what you've learned. So people pretend, they're going to play doctor, they're going to play lawyer, they're going to play cops and robbers, they're going to play investor. They're not true investors. And so both of those things we spoke about in the previous segment point to ignorance as the number one cancer that kills financial future and wealth. It eats it alive. I don't know anyone, not a single person in all the years I've done this, don't know anyone that got out of the rat race, got passive income above their expenses without putting some serious time, effort, time, energy, money, whatever, into learning about investing. I just haven't seen it happen, whether it was through real estate, stocks, whatever it was, business. They had to learn some things that were different and become a different person to be able to be a farmer of a flock of geese that lay golden eggs. You got to know how to tend that flock, how to develop that flock. There's certain knowledge to have. So, I apologize for the jargon of covered call writing. It slips out sometimes, but it's not an advanced concept. It's one of the more basic things you can do.
Now, I love covered calls. They're great. Now, going back with this idea of golden goose and golden geese and geeses, and however plural and whatnot you say when it comes to that, thinking about systems. If we had a farm full of golden geese, we would need a system for said farm. Same thing in investing. Why and how, let's just say this, why is it important to have a system when it comes to investing in the stock market, as opposed to just emotions, stock tips and whatnot? Why is it important to have a system?
It's great question. There's a lot of reasons. There's not just one. In Robert's book, really, really important, guide to investing, he has something called the BI triangle. And it's got 3 very important structural components on the outside, mission, team, leadership. And it's got 5 more on the inside. And dead center in that triangle is systems. What systems do is they remove much of the human element to where humans don't make the decisions, the system does, to where the emotions of greed, fear, panic, FOMO, whatever emotions, laziness, the foibles that are inherent to human physiology and neurology, those are eliminated with systems. So when you can McDonald'ize something, that's why franchises do great, is I don't have to come up with the idea. I don't have to come up with, they just run, and there's just a set of standard operating procedures, rules, laws that are followed. And so when you have a system that you develop, it helps reduce the amount of human problems that absolutely come and are highlighted in our default neurology, particularly our amygdala, the fear. I think that's one of the things that Robert, he doesn't talk too much about his time in Vietnam. He crashed 3 times, there's a picture of him in the water where, he had a crash in his helicopter 3 times. And he's told me a few war stories, but I got to tell you, when you've been through what he's been through, buying a duplex doesn't get your heart rate up. You're not really that afraid of, buying a share of stock. Some people just tremble, oh my gosh, I'm losing you can't lose your life. So, his amygdala has been trained. He's one of the most fearless people I've ever met. Dude just doesn't care. He just does not, he just bang, And so when it comes to investing, he just doesn't have that fear. Well, a system can do that. A system can, it just replaces, like I said, those flaws in our neurology, in our human mortal machinery. Fear keeps people from doing things. Financial education is not a hard thing to do. Look, it's free. I mean, you go to StockCast Bonus, you can start getting free stuff, podcast free. It's that people don't want to get their hopes up and have them dashed. That's the big deal. It's not even, you can buy a share of stock for $100, and if it went bankrupt, you'd lose $100. It's not $100 that can hurt anybody. Everyone can. You can go down to Vegas, throw 100 on a table and lose it, and it doesn't even affect your life. It's the fear of having your hopes to do well, and then the fear of not doing well that a lot of people just shy away. They're so afraid of how it would feel to have their hopes not come to fruition. So systems really help people through all that silliness.
Now, my final question, I always like to end on action. Action is so important. We've talked about this time and time again. We can listen, we can read, we can listen to podcasts and all that stuff, but we have to take action. So if I'm sitting here and I'm either an investor or I have a 401k, or I'm just someone that says I have a golden goose, or I'd like to have a golden goose, or I'd like to have a lot of golden geese, what's an action I can take this week to help me improve?
Well, first of all, understand there's different types of assets. There are some assets that serve a purchase just to insure and hedge. So, for example, my gold is akin to a golden egg, and I use that to protect myself if the dollar were to lose value. So I don't get any cash flow from it. It sits in the safe somewhere, and that's how that works. A thing like a Bitcoin is very much the same. A lot of people buy assets based on speculation of the price moving. So the very first thing, if you want to take some action, is start with an asset that produces cash. Real estate can do this, not by flipping a home, but by renting a home. That can produce cash flow. Syndications can often produce cash flow if they're profitable. And then, of course, just buy a stock with a dividend, and you'll have some cash flow. You'll have something that'll pay you every year, 4 times a year, and then start learning about some of these things I spoke about. If a savings account produces a very, very small amount of interest, which is money that it creates. It is a golden goose, very small, very low production, but you learn how to do something called a cash secured put. Well, that's just cash that's secure, like savings, like it's a secure place, and it's just a much higher yield, and it's less risky than buying a stock, actually. There's less money at risk when you do that automatically, because you're getting paid upfront out of the gate. So think about that. Something that is less risky than owning a stock in isolation is available in a cash flow way on cash. Incredible. Buffett does this all the time to the tunes of billions of dollars. He does this way, and anyone can do it. So I would begin with action steps. Go to cashflowbonus.com, get your free stuff if you haven't. Download the book, start learning from us, start interacting with us. We'll take you by the hand and walk you through the rest of it step by step. But yeah, understanding what a golden goose and what a golden egg is, they're both assets. One produces the other just changes value as price of gold changes, or the price of the stock changes, the price of the Bitcoin changes, or the price of the house changes. All those geese that lay the golden eggs have a price tag around their neck that'll change. Don't look at the top, look at the other end of the goose where the eggs come out. That's where you want your catcher's mitt, and catch those golden eggs that come out of there and shoot out of there. So there you go. That's your action.
There you go.
Go to cashflowbonus.com. Start working with us.
There we go. And thanks for ending with that visual as well, with the catcher's mitt.
Not going to erase that, can you?
No, not at all. Well, hey, Andy, thank you so much for breaking this down for us. We appreciate it. Listeners, wealth isn't just about making money. It's about keeping and growing the systems that produce it. And once you understand how to protect your golden goose, you stop playing short-term games and start building long-term freedom. Now, if this gave you any type of value, make sure you like it, subscribe, share it with someone who needs to protect their financial future. And if you want to build and protect your cash flow the right way, go to stockcastbonus.com right now. You'll find free tools and resources designed to help you to invest smarter. Listener, you're not here by accident. You're building something that most people won't. So stay smart, stay invested, and we'll see you next time. Thanks.
Thanks, Del.
This podcast is a presentation of Rich Dad Media Network.